The options market is suggesting today's rally may be overdone, with the Cboe saying they're seeing mostly profit-taking, with investors selling out of existing bullish positions. So what is that telling us about whether this rally can last? Let's bring in Mandy, Cboe's Global Markets Head of Derivatives Market Intelligence. Good to see you.
Good to be here.
So tell us about this setup before we got this rally, what people were doing, what it indicates about whether it was, short covering or a chase or anything like that.
Yeah, sure. I would say the theme in the options market over the past week has been actually just fading large moves in both directions. So last Thursday and Friday, when we got that big sell-off, what we saw was actually mostly monetization of existing hedges. So people who had hedged going into the move, selling out, and actually people adding to upside calls, playing for a rebound, the so-called taco trade, right? And then on a move like today, one big update in the market, the opposite. So people come in, those who had bought upside calls, selling out of it, others adding new downside protection, basically giving the view that upside from here is likely to be limited. So they're profit taking.
What are the views of volatility going out, whether it be equities, bonds, or oil?
Yeah, so the positioning in the options market has obviously flip-flopped quite a bit, and we're seeing big moves in the VIX. But if you look in the oil options market, actually, one of the things we've been consistently highlighting is just that positioning there has been remarkably consistent this entire time, that most of the hedging, the flows that we've seen in the oil options market is people positioning for further upside in oil. So call demand being very, very strong relative to downside put demand. And this being the case, not just for short dated options, which is where typically people go to play these headlines, but also longer dated options. So if you look at like 6-month options in oil, that's also inverted, meaning calls are trading at a premium to puts, extremely rare. So over the past 20 years, happened only 3 times in the past. 2008, when oil went to $140, 2011 Arab Spring, and 2022 during the Russia-Ukraine crisis. All 3 times, oil spent considerable amount of time, being very, very elevated. So the oil options market saying this disruption is likely to be rather prolonged.
A lot of the work that I kind of review every day, people kind of doing this array of indicators, pointed to the overall put-call ratios coming into this week as not necessarily showing extremes of the sort that would be a really clear contrarian signal that the market was bottoming. Where does that sit?
Sure. Yeah. So put call ratio is a very common indicator. I would say maybe it's a little bit less reliable of an indicator because it doesn't tell you the direction of the trade. So
whether people were selling the calls or buying the calls.
Exactly. So the indicator that we look at, which is skew, actually measures the price of the puts versus the price of calls. But that is consistent with the put call ratio declining. So coming into this week, we were seeing lesser demand for downside protection, more demand for upside calls, like I mentioned. I do think in the equity market, there is still this very strong belief that there is a Trump put in the market, and that if we do get a severe sell-off, there's likely to be a policy reversal, capitulation, the so-called taco trade. That's what we saw at the end of last week. Now, whether we're going to get it this time, whether it would actually be effective, given, geopolitical war is very different from a trade war, that's, to be seen. But certainly in the positioning in the option market, indicate that people still believe there is a Trump put in the market, and anytime we get a sell-off, you do see that bullish flow coming in.
Just reading the notes, it struck me as very interesting that since the war began, that there's been a collapse in volatility in tech and AI as people are more focused on geopolitical. That seems like an opportunity potentially for investors who are in that trade right now.
Yes. So relative to what was happening in February. So February was all about the AI trade. And what we saw in February was the volatility of tech names, or if you look at QQQ, the ETF, the volatility of QQQ relative to SPX blow out to a 1-year high, because that is where all the risk was concentrated in the market, was the AI trade. Since then, that has gone from a 1-year high to a near 1-year low as people look away from the AI trade to these macro risks. So what we see in the market is stocks now becoming more correlated. So when AI was a theme, we saw a lot of dispersion, people trying to figure out the winners and losers of AI trade. Now it's all about the macroeconomic outlook, right? What's the outlook for inflation, for growth, stocks and sectors trading much more correlated together, and that is helping to put upward pressure on the VIX.
And just as a quick note, you mentioned that the day-to-day activity seems to be mostly kind of fading whatever that daily move is. Is that pretty much the routine when you look at the options flow? I always, feel like, the kind of zero data expiration options, the heavy activity in that is mostly just kind of mean reversion trade throughout the day.
So specifically 0DTE, we see pretty balanced in terms of like people chasing momentum, playing for reversal, people taking directional views or income. But I would say this fading of the moves, that's more of a recent phenomenon. So what we see actually in February going into this, beginning of March was actually a lot of hedging demand, even when, market was going down. This recent reversal as we've kind of made new lows, I think that's more of a newer development.